Hi, it's Mark Austin here. Thank you very much for joining today. Apologies up front for the technical problems. We won't be able to unlikely we'll be able to show slides today. So just before I hand over to our first speaker, I wanted to thank our gold sponsor, TradeWeb, who has sponsored this event today, and really through them, we're really bringing you this China financial markets post-COVID-19 webinar. I also wanted to thank our endorser, Pasla, for endorsing this event. Maybe a few housekeeping matters just before we get underway. Please, for the best viewing experience, put yourself in full screen mode. There's a little icon on the top right you can do that with. And then just as a reminder, there are 3 sessions today. I'm going to start off with a keynote from HSBC's Fred Newman, and then there's followed by an equities panel and a fixed income panel. The event is being recorded, and it will be available on demand after this event. So without any further ado, I'm going to turn over and introduce Fred Newman, who's Managing Director and co-head of Asian Economics Research for HSBC. And Fred's going to talk about the economic situation in China after the lockdown for about 10 minutes, which will set us up very well for the 2 panels that follow. So over to you, Fred.
At ASIFMA to putting on this very timely event. I remember the last event we had was, I think, at a big ballroom here in Hong Kong, and I certainly hope that we're going to be there again soon and don't have to rely too long on Zoom calls, etc. What I wanted to do today is briefly share some views on the China economy, putting it into context. We've seen a fairly impressive rebound in the Chinese economy actually after the lockdown eased in early March or so. And what's interesting to us from a global perspective is actually the Chinese economy has recovered much faster than other economies that are emerging from lockdowns. Now, it's still very early days, but if you look at high frequency data, the Chinese economy certainly has gotten back on its feet much faster than what we observed in places like Europe and Italy and France in the early days where lockdowns were eased. So from that perspective, it's on a positive trajectory. However, having said that, China's economic recovery so far has been exceedingly uneven. We sort of saw the manufacturing sector surge ahead, but we saw consumption lag. And I think that's a very important observation because on the consumer side, you still have enormous drags. These drags are related to unemployment. Not everybody has gotten their jobs back. These drags are related to financial pressures, particularly for very small enterprises, mom and pop shops who saw incomes decline. These drags are related to uncertainty. So this lingering uncertainty about a potential further flare-up is all weighing on consumer confidence. And what you saw now in the last few weeks is that with the manufacturing sector surging ahead, but consumer spending lagging, you saw a buildup in inventory, and now the manufacturing sector is starting to pull back again because you had that extra buildup in inventory. So from that perspective, it's been fairly uneven, manufacturing surging ahead instead of consumer spending. Now, the other thing that we see in China is obviously that the export sector is extremely depressed and remains depressed. And that is not China's fault. This is really a reflection of the collapse in global demand. But to the extent that exports still are an important sector, and particularly for employment in coastal regions, that remains a significant drag for the Chinese economy as well. So what does this mean for policy action? Well, it does suggest that even though we've normalized the economic activity to about 90–95% of regular levels, there's still scope for more policy easing just to get us to this normalized trajectory back up there. Now, what we heard during the MPC was in line with expectations. The Chinese policymakers did promise more fiscal spending. Surprisingly, they even leaned a little bit more monetary policy to kind of encourage the PBOC to loosen monetary policy in general, but this is not the shock and awe approach that we saw, for example, after the global financial crisis. We have to keep this in perspective. And it's interesting, even in an international context, how China's policymakers are relatively restrained in terms of abetting the overall recovery. We think that more will need to be done, certainly above what has been announced so far, but that on the other hand, that concerns over debt buildups among local governments, for example, the changing nature of the economy will overall encourage Chinese officials to take a very gradual, incremental approach when it comes to stimulus. And that would imply that as we look at the Chinese economy over the next 2 to 3 quarters, you will not see a V-shaped recovery going back to the race. It's going to be gradual improvement, and certainly China is going to lead the world out of this. It has more stable, better prospects going to 2021 to deliver good growth, but we would temper a little bit these expectations by going very quickly back to 6–7% GDP growth for the good old days. And that's partly because Chinese policymakers, in our view, understand the risk of overstimulating the economy in general. Now, that's kind of where we stand on terms of the economics of it. I also want to say a little bit about China's capital market development, because it feeds a little bit into the very interesting panels that we have later on. And it's sort of tempting to think, I think, that the coronavirus crisis, what's happening on the external political side, is all kind of encouraging a move back to state-directed stimulus, lending, control, etc. But we would actually take somewhat the opposite view here, and that is that this crisis, in our view, will likely accelerate some of the financial market deregulation that we've seen in China, some of the developments to encourage even deeper, more robust capital markets. And it's important to understand that for China to really come out of this with sustained growth, we have to reinvigorate productivity gains in the Chinese economy. And productivity really is a function very often on the efficient allocation of capital. Now, it's tempting to think that if you allocate it by directive, you get this efficient allocation, but really we know markets are the best at doing so. And I think actually, contrary to perhaps some of the signals we've gotten over recent years, there's a deep understanding within the PBOC, within the Chinese Banking Regulatory Commission, within the top leadership in the State Council in particular, that free allocation of capital ultimately serves better the economy long-term growth. So what does this imply? It implies that we'll see ultimately very supportive monetary policy, but a focus to deepen equity markets, deepen bond markets. One of the paradoxical outcomes of the COVID-19 episode, for example, is that many people have predicted bond markets to shut down, corporate credit markets to shut down, but the opposite has actually happened. We saw a surge in issuance coming through because the private sector has a very acute need for capital, and the regulator is willing to encourage that issuance of credit. And we need to kind of maintain that momentum, if you will, to really sustain the recovery. So I would argue that the COVID-19 episode really is a catalyst for domestic capital market reform, and you will see that momentum strengthen as we think about the long-term sustainability of this. This also incidentally links into the international aspect of capital market liberalization and the need for further capital in the Chinese corporate sector, be it state-owned corporate sector or private corporate sector, really will also encourage Chinese policymakers to further encourage capital inflows into the economy. So we would look for even wider access of foreign investors into the Chinese equity and credit markets. We would look the Chinese to try to encourage more capital inflows in this environment, partly because we have this demand for capital in China, but also because some of the international political uncertainties that have particularly become a bit more acute in the last few weeks kind of would encourage Chinese policymakers to rely more on domestic currency sourcing funding rather than rely on hard currency funding, for example. And so that would entail an opening of the capital market as well. One example is even the Hong Kong Insurance Connect with the mainland that was opened just recently. Is yet another channel whereby you can essentially have a more free flow of capital both ways. And so again, despite the enormous economic challenges the world is facing, China is facing, we think that on the capital inflow side, this will be seen as a catalyst for further reform. The last thing I wanted to mention very briefly is this idea of globalization and COVID-19. It helps us sometimes step back from sort of the near-term challenges. The argument that we frequently hear is that in a post-COVID-19 world, we see deglobalization forces gathering speed. We see corporates removing supply chains going back into the West, that the political climate will encourage such a deglobalization, if you will. And the question is then, where does this leave an economy like China? Well, it's important to keep things in perspective. What we hear from our corporates when we talk to our corporates is that, yes, at the margin, there's perhaps some operations that may be relocated to the West or to other economies, be re-onshored, if you will, particularly when it comes to PPE, personal protective equipment, when it comes to pharmaceutical items. There's a political element here as well. But if you ask companies in terms of the long-term growth strategies, China remains front and center for every corporation. And so we don't really register that exodus of investment capital from China by foreign companies. In fact, last year, China had yet another very strong year of foreign direct investment because its own growth is such a magnet for many multinational companies. So yes, supply chains may be adjusted, but our feedback and our message is that particularly in the post-COVID-19 world, where China is going to come out earlier than other economies and is going to probably deliver, at least for the foreseeable future, next 2 or 3 years, higher growth than most other economies, China will continue to be a very attractive place for companies to put their money in. So we wouldn't take this deglobalization argument and how it affects China too far at this point. So I hope these very brief remarks sort of help set the scene. I'm very looking forward to some of the panels that are coming up. And I want to thank again ASIFMA for putting on this event, very timely. And as I said, next time, big ballroom, please, and no more Zooms.
Great, thanks very much, Fred. And no, you definitely set the scene very, very well. I mean, as you mentioned, uneven recovery in China, no shock and awe stimulus likely as we saw after the GFC, but China's still leading the world out of this, and we can expect, you know, greater capital markets reform, greater capital inflow, and the long-term growth prospects for companies in China still remain, you know, positive. So I just wanted to move on. I just wanted to mention again the gold sponsor TradeWeb and the endorser PASLA, because we've got our slides working now. And before handing over to Lyndon, just mention that if you want to ask questions through the panels, you'll see the little Q&A icon at the bottom where you can ask questions, and the moderators will pick those up as appropriate and ask them to the panelists. And then in addition, we will have some voting on polls throughout the course of the two panels, and you can see the little polls icon there, and that will also come up as we go through. So without wasting any more time, I will hand over to Lyndon, who will take us through the equity panel, and I think Fred has set him up very well for that. So over to you, Lyndon, to introduce the panelists and the topic. Thank you very much.
Great. Thank you very much for that, Mark. My name is Lyndon Chow. I run equities at ASIFMA. And today I'm very pleased that we're joined by some very strong panelists for our first China panel. We have joining us Tim Batho, who is the Asia Pacific Chief Strategist of Index Policy for FTSE Russell. We also have Christina Ma, who's the Goldman Sachs Head of Greater China Equities. We've got Tae Yu, Managing Director at Hong Kong Exchange, responsible for global client development in the markets division. And we have Mr. Liu Fuzhong, the Director of International at the Shenzhen Stock Exchange. Maybe without further ado, let's just kind of kick off. Today, we plan to cover a few themes. We plan to cover how is China continuing to reform its markets to attract global investment as it emerges from COVID-19? What are some of the key market and regulatory developments in 2020? What do investors need to see to continue to grow their investments in China? And how do developments in China compare with other markets within the region? So I think Fred did a great job of setting the stage. I think, you know, in the early months of COVID-19 and extreme market volatility, it's quite a lot of grim prognoses with respect to the markets in general and China specifically. What I'd like to do is rather than just you know, stick with impressions, turn to some actual numbers. And I would like to maybe turn first to Tay from the Hong Kong Exchange. Stock Connect has clearly emerged as the primary channel for foreign investors investing in the A-share market in China. So perhaps Tay can just kind of share with us, in the past few months, amidst COVID-19, the extreme market volatility, what has Hong Kong X seen in terms of actual flows into the A-share market in China? Tay?
Thanks, Lyndon. Good morning to all of you. Thanks very much to ASIFMA for allowing me to really join this great panel. Just allow me to share a couple of points from the COVID-19 market volatility situation coming out of that and what we have observed in Stock Connect, in particular dealing with the inclusion elements coming into month of March for FTSE inclusion, as well as last Friday, MSCI inclusion. So overall, the picture is this. The China market, Asia market has been extremely steady. And I think all of you who are in the industry have seen that foreign participation of the Asia market trading essentially had a little bit of a slowdown during market volatility. But overall, the market performance has been outperforming the rest of the developed markets, as well as the other Asia markets as well. And what we observe from Hong Kong Exchange, there are a couple of elements that comes out to play. First of all, the acceleration of Shenzhen market compared to Shanghai market really started to take shape sometime about 1 year ago. And that when you look at daily turnover, you start to see a lion's share of daily turnover getting bigger and bigger for Shenzhen Stock Exchange compared to Shanghai. And that continued to be the case during the month of March and as well as April. The daily turnover definitely for both Shanghai Shenzhen combined stood well over 80 to 83 billion on average daily turnover basis. But what is interesting here is the portfolio value of assets under custody. What we saw coming into end of February is fairly steady line, January, February, of somewhere around 1.437 trillion RMB, right around that level. It stayed fairly steady on that. And in month of March, we saw a slight decline of 1.298 trillion renminbi. And again, that's when Asia market did decline more than 10%. However, having said that, in month of April, we're right back into the game. The portfolio value came right back in as 1.45 trillion renminbi. And the other element that we find very interesting is that the number of shares that are held in SPSA accounts continue to be steady. It is now, as end of April, tipping scale slightly close to 70%. So that means SPSA accounts, number of shares held, are 70% of the overall northbound the shares that are held for all the international investors, which is quite interesting because when you look at that number from 1 year ago, it's April of 2019, we were roughly barely around 52 to 55% range. So what you saw is from 50% to 70%, essentially 20% growth as the overall market assets under custody grew to well over 1.45 trillion. The number of shares that are held in SPSA has grown just as well. Now, the SPSA accounts, we're now standing at over 10,300 SPSA account numbers. So this continues to be a growing trend. Now, there has been a little bit of slowdown in the new SPSA accounts opening during the COVID-19 period. But coming out of that, we're starting to see a little bit of new growth of new application coming in. All in all, the headliner continues to be the same. Asia market is a growing market for many of the global investors, and that growth trend continues to build momentum coming out of COVID-19 volatility. Back to you, Lyndon.
Okay, great. Thanks very much for that, Tay. So I guess you echo some of Fred's comments earlier based on what you're seeing in terms of the inflows. The inflows continue to remain strong. I recognize that our audience today may be a different audience to whom we typically speak to. Probably there are many non-ASIFMA members or people who are not as actively engaged in the marketplace. So perhaps it's worthwhile to just spend a little bit of a quick background. So Stock Connect is a channel of access linking the Hong Kong Stock Exchange with the Chinese exchanges. And it's been a very, very effective mechanism which largely led MSCI to include A shares in its emerging markets index, announcing it in 2017, beginning in 2018. And what we've seen since the inclusion of MSCI A shares into MSCI's emerging markets index is the foreign share of China A share has doubled from 1.7% over 3.4% just within the span of a couple of years, and it's even higher now. In the SPSA accounts that Tay had just mentioned are kind of the vehicle through which foreign investors invest through Stock Connect onto both the Shanghai Stock Exchange and the Shenzhen Stock Exchange and through kind of an omnibus account type structure. So these are very, very positive elements. And Stock Connect has been so successful the past couple of years that I think there's been more of a growing focus by the Chinese regulators to want to also improve the traditional access channel through the QFII and RQFII. So they had a QFII consultation early last year. They've announced the abolition of the QFII quota September last year. They're starting to trickle out some additional announcements about regulatory reforms for the QFII channel. And maybe I can turn now to Christina, who runs Greater China Equities for Goldman Sachs. And Goldman is one of the early powerhouses with an onshore presence in China. They have domestic brokerage capabilities as well as offering channels of access through Hong Kong through Stock Connect. Maybe Christina can kind of just share with us, what are you hearing from your investors? You see some growing action to try to stimulate more QFI reforms. How do your investors look at the various channels of access into China?
Thanks, Lyndon. So I think for our clients, I mean, as you mentioned, QFII was the original investment channel into China. But I think when it was first launched, it came with quite a few restrictions, including you had to get the license, you had to get an actual quota from SAFE, and then you had to repatriate onshore, et cetera, et cetera. And then with the advent of Stock Connect, I guess at the end of 14, I think the clients really embraced this new channel investment because it made things a little simpler. Now, the contrast between the two channels is quite clear. Connect right now remains decidedly just a stock channel, versus QFII allows you not only multi-products, but also multi-functions. So as a QFII, you can invest, or you can use, you have access to hedging instruments, you have access to the block window, you have access to the IPO window, which unfortunately the Connect channel doesn't. So I think to your question of what are our clients doing, I think very much to what Tay spoke to earlier, which is we've definitely seen an uptick in investments and volumes into China this year. And our clients, I think overall in the last few years have, for the majority, used Connect because of the ease of access, whether it's from cash, i.e. the SPSA channel, or from swap. But increasingly, we've actually fielded quite a few questions around QFII and our QFII channel. And this is directly related to the QFII QFII consultation that was launched a year and a half ago, I think almost. Within the QFII QFII consultation, there are a number of reforms that are proposed. I think there was sort of 12 or 13 key ones, and all of which I think our investors are very excited about. Whether it is, ability to invest in a broader product suite, as well as ability to invest in potentially PFMs, as well as access to the onshore stock borrowing lending market, etc. So I think all in all, investors are generally very excited about the reforms. I think everyone's just anxious for the reforms to actually be approved and rolled out, because this has been discussed now for the better part of a year. And I think a lot of us, whether it's on the broker side or the buy side, we are now trying to get ourselves ready for the new proposals or initiatives that have been outlined in the QFII channel. So it is, we're just waiting for the approvals to come through and also the details to come through. I think one of the biggest things that got clients excited about the QFII channel was some of the new developments that happened last year, i.e. the launch of the STAR board, so the NASDAQ of China, as well as the Shanghai London Connect or GDR conversion program. So I think with the proposed GEM board reforms that I'm sure that Liu Zong will cover later on, I think there's a lot to be excited about in terms of investing in China. I think our investors and ourselves, we just want the details to come through and for us to be able to move forward.
Thank you, Christina. That's a great segue to Liu Zong himself. I mean, Tay mentioned this already. We've seen a significant shift of investor flows away from Shanghai towards Shenzhen. This is consistent with the global trend that we've seen in terms of investment in the big tech companies in the US. And certainly we see that around the world, and hence it's not surprising significant shift away from Shanghai towards Shenzhen. And this year also marks the 30th year anniversary of the Shenzhen Stock Exchange. And I'm sure that Mr. Liu has quite a lot of pleasant surprises and gifts for the marketplace in store for this year to celebrate the 30th birthday. Perhaps, Mr. Liu, if you could help guide us through some of the reforms that Chinex are planning to launch in this coming year. Hello? Fuzhong, we can't hear you. Millie, can you help? Can you help with the video?
There are some issues from his end, so
okay.
Yeah, we have to give him a couple of minutes.
Okay, all right. So we seem to be having some technical difficulties. We'll get to Fuzhong with respect to some of the plans on the Chinex board shortly. Maybe in the interim, we can turn over to Tim. So I had wanted to kind of hear or have all of us hear from Fuzhong with respect to some of the plans on the Chinex board. Certainly, Christina mentioned some big reforms on the STAR board on the Shanghai Stock Exchange last year. Changing the IPO mechanism from an approvals based, application based to a registration based, making the standards for listing much more flexible. Taking the opportunity to improve or to internationalize some of the secondary market trading practices, including more significant volumes of securities lending, wider price bands, price limits, et cetera, et cetera. I'm sure we'll hear more details from Mr. Liu later on when he joins us. But I'd like to turn maybe first to Tim, because you cover strategy for FTSE Russell across Asia Pacific. I know there are many markets that you're looking at. Certainly, we're cooperating with you to review some of these markets and to help with market development, with market reforms. How do you look at the reforms that you've seen so far in China? Sorry? Oh, you're back. Okay, you're back. Hi, Fuzhong. So, sorry, Tim. Perhaps we go back first. You can hear Fuzhong with his basket of surprises, and then you can maybe help to overlay some commentary on top of that. So Fuzhong, we're just talking about, this is the 30th year anniversary for the Shenzhen Stock Exchange. Hats off to SESE for significant inflows into the Shenzhen Stock Exchange on the back of technology investments in the technology sector. I know you've got big plans this year to improve the Chinex board, to attract more corporate issuers and to attract more investors to that board. Perhaps you could share with us a little bit about the plans that you have this year for the Chinex.
Okay, well, thank you, Lyndon. And thank you for inviting me to join the ASIFMA webinar of this year. The biggest reform on the Chinese market will be the Chinex reform. So this reform is actually an integrated reform with the registration-based IPO system implementation and the Chinex reform itself. So well, a little background of the Chinese IPO evaluation system. We used to have a merit-based evaluation system. So every potential IPO applicant will submit their application materials to the CSRC for evaluation. Since it's a merit-based evaluation, and a lot of people would view that as an implicit endorsement by the authorities for the IPO. It's not entirely based on information disclosure. So the reform to the registration-based system give the market a greater say in deciding the valuation of an IPO project. So in this case, the new registration system is in line with the government policy to have efficient allocation of capital resources. So this year, the Chinex reform will
Oh dear, technical difficulties again. I found using Zoom that I really need an incredible bandwidth. I've tried Wi-Fi and it doesn't work so well, and I had to upgrade my 4G. I don't know. I think Fuzhong needs a 5G network. Fuzhong, we lost you. Millie, can you reach out to him?
Yes, we do.
Okay, thank you. So sorry about that. A host of technical difficulties really echo Fred Newman's call out for more physical meetings in the future where we don't have these issues to contend with. But nonetheless, yeah, so I think Fuzhong was going to talk more about this registration-based system. For those of you unfamiliar with trading on the Chinese bourse, they have more restrictive price bands, trading rules. There's been a historical scarcity of shares on loan for securities lending, and Shanghai through the Star Board last year tried to tackle that and make securities lending a lot more commercially oriented. And I think Shenzhen is planning similar measures, also expanding the price band, allowing more fundamental, price discovery into the exchange mechanism. So these are all positive developments. I'm gonna turning back to Tim, and I'm sorry for cutting you off earlier. And when Fuzhong comes back, we'll need to just kind of cut his section into two. But Tim, so you're the strategist for FTSE Russell, and you look across the markets in Asia. I mean, it's very clear, I think, to the marketplace. It's just growing competition between exchanges. You see all these shifts towards weighted voting rights and to corporate weighted voting rights in order to draw issuers and to draw investors. What do you see around the region, and how does China benchmark relative to other markets in terms of the reforms that they're making?
Okay, thanks, Lyndon. So obviously China is making somewhat rapid progress on a number of fronts. I think the point that Fred made earlier is a very interesting one as to whether the aftermath of COVID-19 actually does accelerate reforms a lot quicker than perhaps they have been, because there's a need to attract capital onshore for all sorts of different reasons. Historically, I don't think that has been quite the case. Yes, there's been competition amongst the exchanges for listing, but in terms of capital market reform, I don't think that competition has quite been there. But I think it's going to be a very interesting landscape going forward, because all countries will be in a similar position. So the likes of India or Vietnam will equally be looking to attract capital into their markets. In terms of the rate of reform, I think obviously different markets take different paths to that reform. Historically, you know, that they have been fairly patient and have wanted to ensure that local market participants are not disenfranchised, that there's equity in terms of treatment among international investors and domestic investors. I think that will continue as the reform builds. But I think there's a commonality amongst many of the emerging markets within Asia in terms of where the next stage of reforms might come from. Development of true DVP systems, how foreign ownership limits are raised, how corporate governance evolves. So there's a range of different things which I think will come through. So markets which are on our current radar include Vietnam, that's a potential promotion from frontier to emerging. On the fixed income side, there's conversations with Malaysia. India, because of its size, is always on the radar, and people could actually say that market has regressed somewhat over recent times. But I think certainly over the last year, there has been changes there to try and deal with the foreign ownership limits and things like that. So I think China is in a similar situation. What I think the advantage that China has, I think, is that it can bring to bear more resources and can move quicker if it chooses to do so. And it will be interesting to see whether that's the case going forward.
Thanks, Tim. Do you have a top one or a top three that your constituents are looking for in terms of future reforms from China to move into the next phase? I know you're now at a 25% inclusion factor for China, MSCI at 20%, but for them to move into kind of the next chapter, is it DVP? What are some of the key criteria that FTSE Russell is looking at based upon feedback from your constituents?
So I think it's worth differentiating between the two access channels as well, because the reason, as you've mentioned, the reason for inclusion for both MSCI and ourselves has been that Stock Connect has addressed many of the things that international investors wanted to see in terms of a DVP function, and you know, the no need, the lack of, if you like, the registration process is a lot simpler, all those sort of things. But the reality is that Stock Connect, I mean, there could be incremental additions to the capitalization that's included on the back of Stock Connect, enhancing one or two things. The key ones on the Stock Connect side would be the breadth of the market would be one. So as we mentioned, Star Market and other technology things are not currently available through Stock Connect, neither are derivatives trading to any great extent. So those type of things which would aid the functionality are definitely there on the Stock Connect side, as are the mismatch between trading days is definitely one of the things which is highest on the agenda of people that we talk to within our advisory committees. But the real impetus and the real change is going to be if our QFII and QFII enhancements that are in train and are certainly forecast happen, because that will make a completely much bigger access route open for a larger majority of people. And DVP is undoubtedly the number one issue there. That is what people want to see more than anything else. Another thing that goes across both markets is what's called omnibus trading. So that's the ability to be able to purchase a stock for multiple clients and be able to allocate it on the same price across all of those accounts. So from a best execution, that's definitely part of it, as would be the use of multiple brokers on the QFII RQFII route. So those, in highlight on the RQFII QFII, it's more about the DVP and access to multiple brokers. On the Stock Connect, it's more about the mismatch in market holidays and access to a broader array of investment opportunity.
Great, thank you, Chen. That's very helpful. Many of us are going to be part of a China Equities Working Group meeting this afternoon, and we're in the process of prioritizing the industry ask in terms of equity reform. So what you just mentioned is largely in line with the feedback that we've received so far. Thanks very much for that. Fuzhong, are you back?
Yes, I think I'm back. Can you hear me?
Okay. Yeah,
okay.
I can hear you now. Okay. So, yeah, sorry that you were cut off earlier. Yeah, you were talking about the reforms on the China export about moving towards the registration-based system. Yep.
Well, thank you very much, and sorry for the technical issue. So I was just talking about the registration basis system for the IPO. So the reform will have 3 features. The first one is positioning. So the IPO system will focus on listing companies in the creative and technology sector. So it's different from Shanghai Stock Board. So the reform, the Chinex market will focus on companies in traditional sectors with an intention to embrace new technology, new business forms, or new business models. We understand the majority of the Chinese companies are in traditional sector. The Chinese economy is in the process of being upgraded to the next level. So in this process, instead of technology driving the change of everything, it is the traditional sectors embracing new technology or new business forms or new business models to improve productivity. So in that sense, we focus on a wider spectrum of companies and wider sectors so that companies that embrace new technology will be eligible for listing in the reformed Chinex market. And in the system design, it is actually very comprehensive. The second feature is being comprehensive. So the reform will happen not only in the IPO, but refinancing and merger and acquisition or restructuring. So this is a comprehensive reform based on information disclosure. So instead of focusing on the authorities making decisions on the IPO application result, it is up to the market participants and investors to decide based on the quality of the information disclosed by the potential issuer. So in that sense, the third part would be a heavy penalty for fraudulent IPO or misleading information disclosure on the part of the potential issuer. So this is going to be very strict, and you could notice that the Chinese government has been making a lot of announcements and public statements about being very strict on misleading information for IPO or any matter in the capital market. So maintaining the integrity and trustworthiness of listed companies is now a very, very top priority. Now, so we're in the process of formulating the detailed implementation rules and the technical setup. Everything is ready, but we need to further fine tuning. So for the next couple of for the coming months, we'll be working very hard to make sure that the Chinex reform will be ready. And that's about the basic features of the Chinex reform. And I just love to echo our first speaker's point about Chinese economy emerging from COVID-19. So the resilience of the Chinese economy is very important and very, very obvious. China will be the first country, is already the first country to emerge from the COVID-19. Already a number of innovative practices have been noticed in our listed companies. and the companies in China. It will be very interesting to see how the Chinese economy and Chinese companies will emerge from this public health crisis. Well, it all comes up to the basic economics. So the Chinese businesses are making innovation in reducing the transaction cost, taking advantage of the economies of scale, economies of variety, and capturing the emerging demands for new technology. So I have a very some stories to tell about each of these innovation models in the Chinese economies, as we notice in the Chinese capital market. Well, first is the reduction of transaction cost. There are a number of manufacturers that are scaling up production, as our first speaker has mentioned. It's important for the sales to get through to the market. So live stream sales has become a very important tool. So now we've seen widespread live streaming sales promotion online. And I think this is the way that the manufacturers could reduce the cost of delivery, cost of promotion, and that the middleman, getting rid of the middlemen and getting directly the message and the sales to the customer. This is a manufacturer to customer business model is now taking hold. And for the economy of scale, it's very interesting to notice that in Shenzhen Stock Exchange, one of the electric car manufacturers has turned itself into a PPE manufacturer. It's very simple because that company has very clean environment to produce car components. So using that environment, they're able to manufacture PPE like face masks. So they could very easily scale up production and sell the PPE products overseas. So I think this is the story of Chinese manufacturers taking advantage of their existing infrastructure and boosting scale of production. And capturing new demands for technology has been very interesting in China, since China has very good internet infrastructure. So as the country was gripped by COVID-19, hundreds of millions of people were using the internet for online class, online meetings, and the businesses were turned into the online space. So in that environment, a lot of the interesting development have taken place. For example, VR and virtual reality and augmented reality technology has been applied for sales and even for the medical imaging system in Wuhan, and the epicenter of the COVID-19. So doctors all over the country could use remote diagnosis system to participate in the diagnosis process in Wuhan, even though doctors are located all over the country. The installation of the 10,000 bed hospital in Wuhan was amazing, but actually that was aided by the satellite guiding system. So the laying out of the framework and the foundation for the emergency hospital was possible just in an overnight. So that's new application of technology that was available but did not find that use case. We also noticed business diversification. We have a listed company that produces water purification system. So during that COVID-19 process, and they convert themselves into a manufacturer health product for digestion problems. So just to respond to the first speaker's statement about the Chinese economic resilience, we could see that Chinese businesses are taking advantage of the new demands and the existing technology, making innovation based on or in response to market demands. So that's the new development and observation we have from the Shenzhen Stock Exchange. So after the China X reform, we'll be able to admit many emerging companies out of COVID-19 in the health sector, the IT sector. So many of the business models that emerged from COVID-19 will probably stay as many of them have a tendency of tax dependency. So hopefully, after the reform of the China X market, we'll be able to list companies in emerging sectors and new business models that could really revolutionize or disrupt existing business models.
Great. Thank you very much,
Lyndon.
thank you, Fuzhong. And I think that the market hopes that you know, China X is unveiling these new measures a little bit later than on the Starboard in Shanghai, but we hope that the Shenzhen Stock Exchange will beat Shanghai Stock Exchange in terms of making this available to us through Stock Connect. So I hope that that happens before Shanghai. So I wish you Godspeed in making that happen. So hey, I realize we're running out of time. We only have about 4 minutes left. I just wanted to ask, since this panel is focused on COVID-19, if any of our panelists would like to speak to emerging from COVID-19, is there anything that you would be doing differently with respect to your business models emerging from COVID-19? You don't have to if you don't feel comfortable, but if you have something to share, you're more than welcome to share.
Sure,
Yes.
I'll jump in here.
Sure.
So I think you know, we obviously none of us had anticipated what COVID would bring, and I think we sort of operated on 4 key principles. Where once we got the news, we were immediately reduce the density in our office and encourage people to work from home. We split the teams. We then marked people into critical or non-critical and staffed accordingly. And then now, obviously, we have a phased return to office. Now, I think, you know, it's hard to see how much flexibility there will be allowed in the workplace going forward. But certainly, I think what COVID has shown us is that we are capable of running a full banking business from home. I think many of you have seen the stats that at one point, I think Goldman had 98% of its workforce working from home. Now, within the obviously that varied from division to division. I think specifically for the markets division, which I'm in, we were at the height in Asia, 80% of our population was working from home. So I think COVID showed us that a lot is possible from working from home. But at the end of the day, we are still a people's business. So face-to-face contact, interaction with clients, and doing conferences like this in person is much more preferable to doing it over Zoom. So I don't think we'll go all virtual, but certainly there will be greater flexibility allowed from home. And I think this will also force many clients and as well as brokers to perhaps rethink their BCP plans. I think our old version of BCP plans was that, you know, we'd have an off-site and people travel to that site or a limited amount of seats in those sites. I think our BCP plans will now be changed to incorporate a big portion of working from home, given that we now have the better connectivity, whether it's via Zoom, WebEx, and also I think most people have upgraded with their work at home capability. So there will definitely be changes, but it's hard to predict what percentage, what amount, but certainly it's given us a crash course in how to operate a business remotely. And, you know, we're happy to say that our business is up and you know, we were able to do it without any issues or outages, etc. But it'll be interesting to see to what extent we can operate remotely going forward.
Just a follow-up question, Christina, how much of that has been, have you been able to extend to your China operations onshore?
In China, we were actually, I think the stat was 98% working from home immediately.
Oh, wow,
in the week,
that's good.
immediately after Chinese New Year. We only had, I mean, basically a very, very small core amount of people working in the office. And again, it was the sales and trading personnel because we had not then at that point fully tested out trading at home capability. But we are now more than 50% back. So, and I think in every region and continent, we try to adhere to local government regulations as much as possible. And certainly in China, China very much led that work from home process thinking, and I suppose the risk management. So it was a little nerve wracking, and I'm not sure how much of a Chinese New Year break our China people had, but it was exciting nonetheless.
Okay, cool. Hey, I apologize. We've run out of time. We were thinking about doing a polling question, but we've run out of time. So I'd like to just thank all of our panelists for joining us today for our first webinar, virtual webinar on China financial markets. And maybe I pass now to my colleague Rebecca to take over on a fixed income panel for China. Rebecca.
Hi. I'm delighted you all can join us. We have a terrific panel here today that I'm going to introduce right now. I'm just a little bit of housekeeping. We are running a few minutes behind, and we expect to be ending the panel sessions at 12:15. Introducing the panel, and I'm just waiting for the slides to go up. Okay, there we go. Introducing the panel, we have Alistair Gilmore, who's a fixed income trader for Capital Group, Linan Liu, who's the head of Greater China Macro Strategy for Deutsche Bank, Yao Zhou, who's a director in fixed income at SumScope, Eugene Cheng, who's managing director and head of China for TradeWeb, and myself, and I am the head of fixed income here at ASIFMA. We have several questions today that we want to answer about the Chinese domestic bond and repo markets, the fixed income markets, and it would be interesting to follow up on Fred's theme about how these markets should be catalyzed for growth. We're going to be touching on different perspectives on the onshore domestic bond market, the repo market, and we're going to discuss key market and regulatory developments for 2020, as well as thoughts we may have and suggestions we may have to local regulators for making these markets even more efficient. And finally, we're going to end with some discussion around how we expect China to differ from the rest of the world in the fixed income space going forward. So with that, I'm going to ask Alistair if he could sort of share the buy-side perspective on the domestic bond market since COVID-19.
Thanks, Rebecca. Hopefully you can hear me okay. You said, we at Capital Group, we've been investing in the domestic bond market in China for just about 3 years now. And to be honest with you, the short answer to the question as to how that market's been affected for us by COVID is it's been, not been affected very, very much. We've not seen any issues in terms of liquidity in that market. We've not seen any issues in terms of being able to contact and continue to interact with our counterparties in that market. We've not seen, a pickup in operational issues or difficulty, within that market in the past couple of months. So if we compare it to some of the other bond markets in Asia, where we have seen things like markets being closed for a period of time, or reduced operating hours, or increased difficulties in terms of getting trades settled with our counterparts, then China really has come out of it pretty unscathed. I think ironically it's been a good advert actually this period for the resilience of the Chinese bond market. It's the first time we've gone through such a period of market stress with, I think, a notable presence of foreign investors in this market. So I think they will be taking, the fact that the market has continued to function in such a smooth manner as a pretty big positive. And I'm just thinking, some of the reasons as to why that has been the case, why the local Chinese bond market has continued to function in such a way. Well, I think a lot of it's to do with really the breadth and diversity of investors that we have in that market now, where foreigners are a small but growing presence, but also the domestic banks, pension, insurance companies, they've all continued to work in this market to provide liquidity, to be active, and so that's helped the market continue to function. And also, I think the fact that with the likes of the Bond Connect platform being there connecting everybody electronically, then some of the frictional forces that perhaps you may have got with people working from home or working from business continuity sites, etc. They're reduced if you can interact electronically, and that it doesn't really matter for me, for example, if I'm logged in, in my office or here at home, we can continue to speak to the same kind of parts and interact with them in the same way as that. So, as I say, in summary, I think it's been a relatively positive outcome for the Chinese local bond market from the perspective of a foreign investor like us, and certainly I think it's increased our confidence, our comfort that the Chinese bond market can continue to function smoothly in periods of disruption.
And how do you see the investor behaving over the course of the rest of the year?
Yeah, well, it's an interesting one for China specifically. It's going to increase or continue to increase its weightings in a lot of the benchmark bond indices, whether it's emerging market focused or developed market focused. Credit to the Chinese authorities, they've done a lot of work over the last couple of years to secure their presence in those markets, and that acts like a magnet for foreign investors. So I think we'll continue to see foreign investors increase their presence in China, and I think be a lot more active going forward.
That's interesting. And Linan, do you see a similar pattern, or do you see something different?
Thank you, Rebecca, and many thanks to ASIFMA for hosting the event during such challenging times. From the south side, in fact, it has also been challenging given we will need to follow social distancing measures, but also need to maintain regular market making. So we have our teams sort of in split operation format and trying to provide as much liquidity as possible to our investors. And what we can observe, I would highlight perhaps three things. Definitely, there has been continued inflow by foreign investors, and that's been the focus of our offshore market making activities. Just simple statistics, for example, by the end of April, we have foreign investors held about 2.37 trillion of renminbi bonds. That's roughly $330 billion US. Foreign ownership of domestic bond market is 2.3%. And the net inflow so far during the first 4 months of this year, cumulatively at 108 billion of renminbi. Although foreign ownership of the total market was almost unchanged right now versus the end of 2019, as a share of government bond holdings, foreigners actually increased the holdings by almost 1% from the end of 2018, currently at 8.27%. Last year end at about 7.85%. So there has definitely been continued inflows, and you can see that from the Bond Connect statistics as well. There has been more account openings so far. There's been close to 300 new accounts added to the Bond Connect program during the first 4 months of this year. Also, trading volume surged by 70%. Daily trading volumes on average for the first 4 months at 18.3 billion RMB. That's roughly $2.5 billion per day. But also interestingly, I think the market behavior has also been changing in response to policy stimulus post COVID-19. Initially, China has delivered monetary easing in terms of liquidity injection, reserve requirement ratio cut, and interest rate cut, and the market has enjoyed a bullish run, and that has also taken part by foreign investors. But lately, given the fiscal stimulus package, which increased overall financing, net financing by the government by about 3.6 trillion RMB from last year in the form of, for example, 1 trillion more of fiscal deficit, 1 trillion more of new special COVID-19 government bond issuance, there's a 3.7 trillion of special project bond financing by local government. That's more than 1.6 trillion more compared with last year. So there were, because these debts are mostly long dated, so we definitely have seen foreign investors selling long dated bonds. So overall, the curve shape has actually, deepened at the long end, and we're seeing, for example, the China-U.S. long-term interest rate differential widened to over 2%. So that's something we're monitoring. And last week there has been somewhat flattening because money market rates went up. But so far, we do see a lot of foreign selling at the long end. On the other hand, because currency renminbi has become more volatile lately, we do note investors are buying the renminbi bonds on a FX hedged basis. That's slightly different from what we have observed by the end of last year, when there's a decent momentum in terms of expecting currencies to stabilize. But also onshore FX hedging cost is relatively cheap, and therefore most of foreign investors have taken the FX hedges on the onshore market.
And that's interesting. And do you expect these trends to continue for the rest of 2020?
I do see in the next couple of months there could be more of a currency volatility given recent events. But I would say most of investors are still investing in the renminbi bonds for index inclusion, index tracking, as well as for reserve diversification. So that is still positive structural demand factors from foreign investment. But on the other hand, currency volatilities might slow down the inflows. People might want to wait for cheaper levels to participate in the renminbi bond market. So there will be volatility for the rest of this year.
Thank you. Yao, I'd be very curious. I think we're all very curious to hear your thoughts on that and see how they represent those of people who are studying the markets from offshore as well. Yao is in an interesting position because he works for the largest local data service provider in the fixed income space in China, and really has his finger on the pulse of what the local investors are doing. What's your thinking about the fixed income market and the bond market? And if you could speak about the repo market as well since COVID-19.
Sure. Hello, everyone. So I hope you can hear me clear. I am the Director of Fixed Income Specialist of SumScope. Our company focuses on both onshore and offshore RMB bond market, especially for the onshore bond market and the fixed income area. So we provide data and other consulting service to financial institutions and regulators. So talking about the COVID-19 impact, it's very interesting. If you look at for example, normally for onshore investors, we look at the 10-year CDB bond as the most liquid and the popular bond. So if you look at the yield of that bond level, you can tell the market it constructs like 3 different phases after the COVID-19. First phase is since the February 3rd, the market has been hugely impacted, and the yield drops like 20 bips for CDB bond for 10-year CDB bond. So that's a 10-year biggest drop for the yield for that bond. And until the middle of March, and that rush, that overbought has been corrected, and the people start to think about that. How about economy recovery? So after the middle of March, the market started to hesitate and to think about, well, maybe the economy recovers well. So when the March PMI data and other economy data comes out, well, the market started to enter the phase 2, and then now it comes to the phase 3 after the first day of May, because people have all seen the good recovery at least so far, the good recovery of the economy. So talking about the data, if you look at the if you look at the Treasury yield curve surface, the risk-free rate, you could easily see that both the short and the long end, they drop at the first, and then they climb up the second. And so that means that the market, there is a expectation gap for all the participants. I mean, especially for those traders. And talking about the repo market, as you mentioned, for the last year, the 7-day repo and the overnight repo, I mean, for the onshore market, it's been quite stable. For example, for the 7-day repo of last year, the rate is almost all about 2.5%. But after the COVID-19 impact, and the central bank has placed a lot of precautionary policies and try to inject much more liquidities and cut the rate of the market. So that rate comes to like 1.5% for the overnight, for the 7-day repo. And for the overnight repo rate, it also comes down dramatically since the COVID-19. But now it recovers a little bit since the better than expected economy data, and also due to the central bank and other regulators try to say adjust the market reactions, because they don't want to let the market to be in, I mean, for the fixed income traders, they don't want to indulge them and to let them know that, hey, the liquidity is not unlimited, so just pay attention to your liquidity management, so that both the 7-day repo and the overnight repo comes up like 20 bips. And look at the monthly trading value of those repo. We have statistics both from CFIN's and from our own research. For example, last year, think about a trading volume for overnight repo, because for the onshore market, overnight repo takes over accounts like 70%. Last year, the overnight repo accounts for like 70% of all the repo trading every day. But this year, especially since the COVID-19, I mean, since February of this year, that accounts almost at 80%, because due to the low interest rate of the short end, because the central bank has given the market a very clear signal that, well, we're going to keep this market safe and don't worry about it at the first stage. So that's why the repo, also the monthly trading volume comes up like 20% if you compare to last year, either for overnight repo and the 7-day repo. So that is basically about the repo market of the onshore fixed income market. That means that, in summary, at the first, people rushed to a low interest, but now it comes up a little bit, and then the traders start to calm down. And also, so there are some other interesting facts I'm going to articulate. Well, if you look at the very interesting, the on the run, off run yield spread of the 10-year CB bound, there's a very interesting development. And also you can count, and according to our statistics, for the first day of since the COVID-19, I mean the February 3rd, people rushed to both the on the run and off run, the 10-year CB bound. That's not normal to see when the on the run bond have been the most popular, have been the most liquid bond in the market. Normally people just move their positions to the on the run market, but after the first day of the COVID-19, people rushed to it, and then the multiples, I mean, if you use the number of trade on the round and to be divided by the number of trades off the round, that multiples goes down almost less than 2. That means that almost the same for both the off run and on the run and off the round. That's really rare to see during the last 5 or 6 years. So that means that the market was really panicked. There is a panic overbought since the very beginning, but now it's in a correction tunnel, and after the market start to come down. And also to say, if you think about the comparative trading value strategy, there is a good opportunity, for example, based on the data of both the bond and the treasury futures. There's a for example, in terms of the comparative value trading strategy, there's a potential winning opportunity. I mean, with high potential of winning for the butterfly strategy. I mean, if you short the midterm like 5 year and the long, the short and the long end, for example, like a 2 year and a 10 year CDB or the treasury, we just the market just normally people would choose the CDB bond due to the better liquidity. So you could that spread of the butterfly strategy reaches like a 6 year low level. So that means there is a good opportunity for you to take advantage of the yield curve reshaping. I mean that, and also that represents another concern of the market participants, because after, for example, on March, like on March 30, the 7-day repo was cut like for 20 bips, and then the yield curve started to steepen. But after the May 19, an MLFA rate keeps no change, and then the market started to worry about that. Well, if that means the curve will go to like a bullish steepening, and now this is the major concern of the market participants so far. So basically, that is about how the market is impacted about the repo and the bond and the futures market. Rebecca.
Thank you. That was a very helpful overview, and I'm sure the traders enjoyed the tip on the butterfly strategy. Eugene, do you want to speak to us about how you see the regulatory developments going in 2020? I'm curious to hear whether you share Fred's view that the market's development will continue to accelerate, and we can expect, regulators to move forward in that regard.
Thanks, Rebecca. I hope everybody can hear me well. Okay. Yeah. I definitely agree with Fred's view about I think the China regulation slowed down by the entire this COVID-19 situations. It looks like am I still on mute? Or?
No, we can hear you.
Okay. All right. So I think I agree with what Fred just mentioned. Like it's actually become a catalyst for the China capital, like further opening up. We saw a number of new measures has come out in the last couple of months, like the April, the CCDC, Shanghai Clearinghouse. They introduced the recycling statement service, and also like special settlement cycle. I think previous guests also mentioned the PBOC and SAFE. They officially released that rules. They're going to removing the quota system on Q fee and RQ fee, so that will shorten the market access timing in setting up the RQ fee. And also early this year, there is a announcement to allow the foreign investor to engage in the FX derivative transactions for hedging purpose, not only with their settlement agent, but also can do with other counterparties, so that they can meet with the best executions requirement. So I have opportunities to work quite closely with the regulator and also the CFS. So we really appreciate the huge amount of effort they have put in to make those changes, because a lot of time you require many briefs in order for them to change those existing rules. It also takes a lot of effort to coordinate with many other government agencies, with the market stakeholders. So we believe that like the investors, they always were looking for the great investments, and then the easier you can make for them is a better for everybody. I think Alastair just keep me honest. Like we TradeWeb, like we are a global organization. We actually China is the first market. We have a plan to react to the COVID-19 situations. So we'll be ahead of the curve in terms of getting our staff working from home, getting trader remote access so they can trade from home. So everything actually seems work out seamlessly in terms of this remote access. And then also our clients are quite happy that they can use the electronic access we provide to them, and then we don't have to worry about like the onshore trader they usually talk to, not allowed to back to office because the COVID-19 lockdown. So looking forward, we understand that the regulator is quite determined to make their fixed income market more accessible, especially for the global investors. So we are the first one to link to the CFAS in the Bond Connect. And then also currently we are working quite hard with the CFAS to bring the RFQ trading protocol to the CIBN direct channel. And also that we know CFAS is working to extending the trading hour from currently 5 p.m. to 8 p.m. There is also quite active discussions about the close-out netting rules in the derivative contract in the event of default, and also consider allowing the foreign investor to sign the ESTA document. So those all gonna pave the way for global investor to access the onshore IRS market. Yeah, so we definitely see the China regulator quite commit to opening up their market to make it more accessible for the global investors post the COVID-19.
Okay, look, we do have a polling question we can put up. And if people want to, just share their thinking about what is the biggest challenge of accessing the Chinese fixed income market that you face, and we'll get back to that question in a few minutes. First, I actually want to get Eugene's view on if you had one or 2 points that if you could speak to regulators and ask them to do today to facilitate access, what would that point be?
I mean, I speak on behalf of my clients. I think the regulators are quite listening to all, especially global investors, their requests. So I think that extending the trading hour, that will actually help a lot of global investors who are trading out of London and also trading out of US market as well.
That's interesting. Yeah. Do you have anything you want to add on to that?
Okay, I hope everyone can hear me clear. I think that the regulators have been, say, trying to push the limits and about all the foreign investors' access to the domestic market since the Bond Connect program. So I think about the accessibility and the regulation updates and give the market more, say, like a precautionary or a projection, or just release those official ideas as early as possible, instead of let the market to know at the last minute, and then it will impact the market with say more uncertainties. I think if just on behalf of our clients, especially for those investors in Hong Kong, I think they want to know the market better. And that means more marketing events from both domestic, say, regulators and also the offshore regulators, and to try to connect the connectivity. So because we've been doing this with the regulators, even in Hong Kong, and then they ask for it so much, and even for some basic market. Basic knowledge about Chinese fixed income market training, they're keen to receive our service about this. So I think that is the biggest demand.
Thank you. That's helpful. Do we have the answer to the polling question? Okay, so it does seem that regulation is the audience's view on the biggest friction in facing the Chinese markets. That's interesting. Thank you for participating in that. Alistair, I'm going to turn it over to you. Can you just sort of give us some closing thoughts on how you see the fixed income market, diverging from the West, or maybe it won't? How you see the East-West kind of playing itself out over the next 12 months?
Yeah, no, I think it's going to be an interesting one, because obviously, China is relatively isolated, or a relatively self-contained market in terms of the foreigner participation is growing, but is starting from a relatively low basis. So I think with, as I mentioned before, the increasing of the weighting of China and a lot of these global bond indices, we will continue to see foreigner inflows into the market there, and I think that'll provide a nice tailwind for the performance of that market, and will probably relative to other Western markets reduce the volatility I would expect to see in China. And the rationale behind that is with a lot of investors, a lot of passive investors, of which there is a lot of AUM that follows their strategies. It becomes very formulaic that as the index weightings increase, regardless of whether they like the market or not, or whether the market is selling off or rallying, they have to increase their weightings of that. So in periods of weakness, if the weightings continue to increase in those indices, then money still has to continue to flow into China. And I think, as I said, that will continue to dampen some of the volatility in that there. The other way I think China is probably going to continue to differentiate itself from other Western markets is through not necessarily having direct involvement from the central bank and the government in the bond market itself. So if we look at most of the other developed markets around the world now, from Japan, Europe, US, the Fed, the BOJ, the ECB, they're all there with these bond buying programs, which, like it or not, tends to kind of distort the market in a certain way, and can in ways also increase the volatility in those markets, because it holds them at artificial levels, which when they step away from the market has to suddenly react to it. Whereas in China, the PBOC and the authorities there have a few more tools to be able to continue to adjust the way that money flows around their markets, rather than just having to buy bonds to bring bond yields down to then force banks to then go in on lend to the economy in order to try and stimulate that. So I think the Chinese bond market will be left to kind of relatively behave itself versus some of these more artificial controls that we're going to be seeing across the other Western markets, I think for the foreseeable future in that there.
Thank you. And Leanne, can I just give you a minute or two to just share your final thoughts?
Yes, thank you. I think perhaps from a slightly more perspective, I will highlight maybe just 5 points. First of all, the renminbi asset class is quite sizable, being the second largest economy and perhaps the largest economy in the emerging market. China's equity market and fixed income market both rank the second largest around the world after the U.S. market, and clearly the largest EM asset class. And secondly, the renminbi asset class is starting to open up, and similar to what Alistair discussed earlier, global investors are mostly underinvested in this market. Foreign ownership, as I talked about earlier, just 2.3% in the bond market, less than 5% in the equity market. So this is still well below global emerging market average of foreign ownership of domestic asset class, which we estimate at about 15%. So there's been very strong allocation demand also because renminbi assets are now included in the global equity and fixed income indices. And perhaps thirdly, renminbi as a currency is becoming more internationalized, and this is also becoming a global reserve currency. For the time being, there's less than 2% of global reserves held in renminbi assets. So this is still quite low versus the share of renminbi in the, for example, IMF SDR basket of close to 10%. So there's a long way to go from a global reserve asset allocation perspective. And next, perhaps, is also given, this is emerging economy, growth is relatively higher, so the prospective return from investing in both equities and the bond market is higher than most of other economies, echoing what we discussed earlier about most Western economies perhaps running at zero interest rate and quantitative easing measures to inject more liquidity into the system. But the absolute asset return for bond market perhaps is higher in China. Yeah.
Great, thank you, Lyndon. I'd like to thank all our panelists for joining us this morning and sharing their views on the domestic China fixed income market. I'm going to now turn it over to Mark and Millie to wrap up.
Thank you again for joining us today. Our next virtual event will be this coming Thursday, June 4th, on U.S. support programs for the markets and economy. This is again a free event, so please reserve your seat by either scanning this QR code on the screen or visiting our website www.asifma.org/events. We hope to see you there. Have a good day. Thank you.